If everybody can mind, and I've got a little bit of an echo, if everybody can mute their phone that's on the line, it would be helpful, just because it helps us to control the background noise, and we have a fair amount of folks on this afternoon or this evening's webinar. So really appreciate everyone joining. I tell you, you kind of know you hit a chord when you see the number of folks that signed up for this seminar, and I'm very fortunate that my team, Fernando and Alyssa, and I really put some time into presenting the materials for today. One of the things that I think has come up, and the reason for this call, is I had an opportunity to present in Nashville, and then also have done a fair amount of partner meetings this year. And throughout each one of those discussions, the conversation has turned to what is my business worth, or what's going on across the specialty with mergers and acquisitions. You know, why are groups going to private equity, or why are they merging? And so I realized that there was a real opportunity to educate and really kind of think through, what is your business worth? And at a few of the meetings last year, we did panel discussions and did some conversations around, you know, what is the vision of your company for the future? Do you want to merge? Or what does your foundational platform look like? And I think what we've learned quickly, you guys, if everybody can mute that just joined, we've got a little bit of background music, and I just want to make sure, out of respect to the attendees, that they can hear. I think what I've realized, that in analyzing the financial strength of different companies or different practices, you know, if this were easy, we'd all be known as Warren Buffett, right? This is an art as much as it is a science, but the numbers don't lie. And so one of the things that we thought we'd do tonight is just kind of talk through a little bit of the behind the scenes of what's going on across not just our specialty, but other specialties across the country. And then also talk a little bit about, if you are looking at valuing your practice or looking at what a valuation would look like, what are the types of things that are going to be important moving forward? So without further ado, there we go. So when we think about what's going on across the country, and it's not just urology, it's different health systems across the country. You know, every time you pick up the news lately, it feels like there's health systems merging, payers are merging, you know, EMR companies are merging. And so what we're really finding is there's a lot of conversation around mergers and private equity and conglomerations, but a lot of the deals that are being structured or put together, until people are in it and are really doing part of the due diligence, they're not really sure, you know, kind of who they're married to. So culturally and politically and financially, a lot of these discussions and things have to make a lot of sense for people to move forward. The two, and many of you may have read the news or know this, but the two largest health systems in the Philadelphia area are looking at conglomerating. The two largest health systems in Chicago are talking about this. And then there's things going on like Optum buying up different primary care groups and specialists. And then also a lot of private equity mergers going on, not just, again, in urology, but across multiple specialties. And I'll talk a little bit about why and the other specialties and what that looks like. The biggest thing is really not just understanding and setting the stage for the current environment in healthcare as far as each one of these pillars is concerned, but really understanding and setting the stage for what you want your practice to look like in the future in light of your geography, your region, you know, what's going on in various groups across the country. And I think it's really important for us to think through what a crystal ball could look like. What is your 1 year, 3 year, 5 year, 10-year plan? And if you're going to stay independent in light of all this, what kinds of things do you need to do to make sure that you stay in control of your business and really are setting the stage for a good business plan moving forward? So just switching gears, because I get asked this pretty much in every partner meeting and, you know, quite a bit, but private equity activity in healthcare has steadily increased over the past decade. Strategic acquisitions have too, but we're really watching a lot of private equity activity, and there's a lot of reasons for this. One is there's a lot of what's called dry powder, a lot of, you know, money on the sidelines. That healthcare is a place where a lot of the private equity companies see margin, and they really feel like there's an opportunity to take some of that margin out, but also to consolidate different specialties. And in the community-based space, you know, there's a lot of physicians that are looking at or facing, you know, getting into a point where they've built their practice. They're not sure if they want to practice for another 20 years. You know, what do they do with this wonderful business? And there's no such thing as goodwill a lot of times anymore. You might be able to sell your, patient base or book of business, but it's all about what you're going to do long-term with your group. Payer activity has increased, where if you think about it, with all the mergers going on across the country, if I'm a large healthcare system now in Chicago or Philly, or even in some of our smaller cities in Indianapolis, and I go to the local payer and say, hey, I'm going to negotiate contracts for United Healthcare or Blue Cross Blue Shield, and I have X amount of lives covered, how is a smaller group going to compete with that? And I think that's where, private equity groups realize that, a lot of the groups in the ology space that are community-based are going to have to decide what they want to do long-term in order to play in some of their respective marketplaces. So between the dry powder, the age or maturity of our groups and physicians, and not just us, it's ophthalmology, it's a lot of other specialties as well, dermatology. You're watching this increase in private equity continue. And from what we've seen and gleaned in a lot of the most recent PR pieces that are putting out, the three biggest specialties that seem to be of note in private equity deals this year and next are GI, orthopedics, and urology. And I'll talk a little bit about why that is. So I mentioned this briefly, but we don't want to just focus only on private equity. There's also a lot of mergers going on across the country. There's groups that have decided, we don't really want to go to a strategic buyer at this point. We're not really sure if we're ready to do a deal with anybody outside of our group, but we may want to merge ourselves or possibly join a larger strategic entity moving forward. In urology, we're not seeing really many, if any, hospital acquisitions. Hospitals are running on very low margins, and they've already bought up a lot of the ologies that they were looking to buy up. And some of those deals, worked, some of those deals didn't work, but for the most part, hospitals aren't really playing in the urology space. We are seeing them, a lot of roll-ups occurring across the country in other community-based specialties, like I mentioned, orthopedics, dentistry, ophthalmology, derm, and obviously starting to see really some consolidation in urology. And if you read the most recent market research reports, we thoroughly anticipate that urology groups will continue to consolidate. The whole goal of tonight is not just valuing your business, but consolidating appropriately and also setting the right tenor and tone for how your consolidation takes root, so that you can really recognize the benefits of a consolidation or marriage, if you want to call it that, rather than just moving into a situation where you feel forced or you feel like you have to make a decision. You're going to be in the driver's seat, which is what the hope is on the heels of tonight. So, not to be repetitive, but you can just really see from 2012, and really if you go back, a lot of the deal flow in the United States started in 2000 rather. By 2012, dermatology, dental, and vision being ophthalmology and optometry practices, really started taking off. And that was the initial consolidation. If you talk to either private equities or you watch roll-ups happened around those three specialties, dermatology, dental, and vision. And I'll talk a little bit about this, but initially there were only a few deals, and then over the course of the last few years, those deals have just gotten bigger, and more importantly, the volume of them has gone. Once the few platform groups went, then things continued to grow, and now we're watching what they call, the proverbial second bite of the apple. A lot of those groups are either selling to a larger strategic or another private equity, or getting bigger in order to compete in their respective marketplaces. And again, we continue to see this trend. Dermatology hasn't really slowed down. There's over 20 private equities now in the dermatology space. There's over 20 in the ophthalmology space. And in dentistry, it's hard to say because so many of the groups have been bought by a larger DSO, a dental services organization, or large private equity. So there's quite a few, and the consolidation has continued. I was asked this the other day, and I just think it's an interesting slide, and a lot of these slides will all be available on our website after the fact. So definitely, definitely you're welcome to look into this further. But there's just, as I mentioned, been a lot of consolidation, but the transaction distribution really has gone across multifaceted areas. So you're watching pharmacy roll-ups, I mentioned dental practice managed role, but some of the bigger ones, physician practices and services, you can see on here. Obviously, hospitals and health systems, I mentioned that at the beginning of the call, and long-term care. Interesting in the long-term care market, and there are a few large-scale payers and large-scale strategics that are really buying up, not just primary care, but also bolting on long-term care and also looking at bolting on specialists. And interestingly enough, if you follow, the primary care market or the long-term care market, my famous line is what's in between the two of those, and it's obviously us. So, the important thing if you're going to look at what your valuation is or how you're going to plan the future is if you're bookended on either side by roll-ups and or strategics that own your primary care groups in your area or your end-of-life facilities in your area, just being mindful. Things that are going to become more and more important as we value our businesses or as we look into the future are contract negotiations, obviously managing our book and bottom line, but really looking at how we're going to play. If you consider that a lot of these areas are being spoken for by larger entities, how are we going to play in the future, and what, who are you going to marry, or more importantly, how are we going to align as a specialty to make sure that we're playing at a much higher level? So, there's been a lot of talk of MSOs in urology or large scale entities coming about. I think it's really important to think about as you look at your valuation, how you can align yourself strategically with the appropriate folks in your marketplace. So just to kind of revisit this, but I think this is a very telling area and slide as far as what the size of the urology market is. This is number of physicians who actually still have a urology degree or certification. So the actual practicing physicians is lower than the 12,000. But what you'll see when you look at the number of physicians practicing across the United States, and you can kind of follow the trend line, but, dental, there's obviously a lot of dentists that are practicing across the country, but you can look at where we stack out compared with a lot of the other groups. And what the private equities and or strategics are really thinking about is how do you take a fragmented market in various geographies and start to recognize economies of scale. And so this is happening, like I said, because one, there's a lot of opportunity. There's a lot of what they call dry powder or cash on the sidelines that can be used. The tax implications of doing a roll-up or doing a strategic buyout are very good still right now. That may change as the economy changes, but right now those are very good opportunities for large-scale institutions. And then three, if you look at the United States as a whole, our healthcare system is obviously almost 20% of our gross domestic product. There's a grain of America, not just in our physician base, but in our patient base. And so a lot of these ologies are starting to be really looked at as areas of opportunity. You can't really maximize widget factories and the, IT synergies. The only two areas really that are becoming this prevalent in the strategic and private equity buyouts are like the e-commerce and online space in certain areas, and then healthcare. So you'll definitely see additional deals in these ologies continue. And I think the key out of this call is just how do we really, if we're going to value our businesses, what does that actually look like, sound like, and how do we most productively have those discussions if we have to, not just externally, if somebody wants to come in and talk to us about a strategic roll-up, but also internally. How do you position this with your partners? What do you tell them about the financial intricacies of your practice, and how do you be very transparent about whether or not you want to move forward either with a transaction, a roll-up, or a strategic conglomeration? So I pulled some opportunistic deals that I thought just would tell a very good story. Just to give you a really broad portfolio of one example, the deals that I pulled out for dental, derm, ophthalmology, gastro, urology, and OB-GYN, these are from, and most of you have heard of Audix because of their partnership with Chesapeake, but these are Audix deals that have been done, and you can see the dates. So the dental deal that was done, the dermatology, ophthalmology, gastro, and then of course all of us are familiar with the Chesapeake deal. What's interesting about this, if you follow the trend line, is in dentistry in 2008 there were only 3 portfolio companies at the time of the investment, and now there are well over 30. In derm, like I said, there were 0 at the time of the investment. Audix was really a first mover advantage in the dermatology space. And now there's actually over 20 current year to date as of now. This is just the market has just run. Ophthalmology, same thing. In 2014, when they brought Vision Group, there was only one, again, first mover advantage. And then currently there's over 20 in the ophthalmic space as well. Interestingly enough, some of the newer ologies that have kind of come on board, and this is why we're talking about it so much, obviously Columbus Urology, New Jersey, and DVU all have also looked at private equity investments in the past year and a half. But if you follow the trend line of the other ologies across the country, we're definitely on the beginning and the brink of urology becoming very much a part of the conversation in the private equity space or in the strategic space. And so this is where, as you look at your cash flow analytics, or if you look at building infrastructure this year, or you're really thinking about how to increase your bottom line within your portfolio, this is definitely something that would be a consideration. In a lot of the partner meetings that I've been in the last couple of years, the revenues in the groups are, down or flat. A few have recognized economies of scale or revenue growth. And mainly the ones that have, to be quite frank, are the ones that have either done a private equity investment or have gone through a larger scale merger because they could recognize economies of scale. The important thing, I think, to remember or realize if you're considering this is, what does that marriage bring you, obviously? But also, if you're going to go build infrastructure or you're looking at doing something financially with your group and this is not an area that you want to go, you really only have a couple of options, right? One is to take out a bank loan. Two is to look at your partners and say, hey, we need to make an investment. Let's talk about how we're going to do that. Three is to partner with a larger scale strategic or, look at getting a loan through a CIN or an IDN type of scenario, some sort of economies of scale that way. Or four is to obviously have the luxury or opportunity to get an outside investor. And I think that's the groups that have gone this route, because I'm asked that quite frequently, but the groups that have gone this route will tell you it's a nice place to be, and that you can really look at where you want to go long term if you're looking at building additional infrastructure and or recognizing economies of scale. So I wanted to just kind of break down, in talking about valuation, how does a deal actually even work? And I pulled a benign deal out of it. I didn't want to talk about, obviously, urology. I wanted to pull a benign deal out of outside specialty, and it was an older deal, so we could actually see the maturation of how this deal worked. So just to give you an idea, this was an eye care group out of Central Maryland. At the time that they were built, and this is really important because the one thing I do hear a lot is everybody, I'm a platform group. Everybody's a platform group. This really was a platform group that was vertically integrated. They had an ophthalmic and an optical service side, had 4 good locations. And mind you, this was 4 locations back in 2014, and had a really strong outpatient center that they were really doing well financially, and they also wanted to grow. And like I talked about, when you want to go through some growth, do you go take out a bank loan? Do you dip into your top partner's pockets? They decided that they were going to exercise a private equity engagement. They were very thoughtful about their private equity engagement, and they looked at really what areas of the market would complement what they were trying to build and where they could have a good geographic footprint. And then also their platform group was able to grow at a decent clip. And everybody always says, what is that decent clip, Dana? It's a good estimation. A lot of times you'll hear, hey, the platform group really needs to grow year over year at a certain amount, a certain percentage in order to make it work. And then do they have an extensive healthcare expertise and experience? And this group did have a really good C-suite, a strong foundational platform. Their operations were good. They were, not broken internally. And so over the course of the next, you can look at it, 3 years, they became eye care service partners and basically went from 30 physicians to 114, went from 4 clinics to 44 clinics. A lot of that was optical add-ons, and really were able to, like I said, recognize economies of scale in certain geographic regions that they wanted to move into. They were able to add surgery centers. And this is an area, a lot of groups that are consolidating or merging are really looking at how do you recognize more surgery center opportunities. We see a lot of the hospitals pushing patients back out into the marketplace, and that trend is probably going to continue with bundled payments or payer model initiatives. So absolutely an area of opportunity. They were able to recognize additional surgery centers. increased their states. And then they went from just being ophthalmology and optical to ophthalmology, optometry, and optical, and really became a national leader in the eye care space. So I think the interesting thing to realize about this, if you look at the transaction and what actually it meant, it basically meant that they went from being a small, 4-location group with an outpatient center. And I know this is not urology, but it's very similar to the deals that I think you'll see in our space moving forward. They were able to really increase their physician size, their footprint, their state aggregation, and most importantly, their surgery center. What's not noted on here, but is really important, is also their payer contract situation was something that they were able to negotiate at a very high level because of their new partnership. So why is this important? And it's interesting when I'm in partner meetings or folks ask, how do you value a business? How does a PE value a business? How does a strategic value a business? And you'll hear the term EBITDA, right? EBITDA, and I think most of us have become very conversant on this term over the last 24 months, but really EBITDA, if you think about your company, it stands for earnings before interest, taxes, depreciation, and amortization. The bottom line is the standard method, if you think about it, for calculating your company's profit, and everybody knows this from just, Math 101, right? But it's to figure out your net income, and that all net income is your gross revenue, every dollar you earn, right? Minus your expenses, every dollar you spend. And then when you think about your expenses, a lot of times as a business owner or as a practice owner, you're thinking about your raw materials, your manufacturing, or your patient care costs, your rent, your space, your employee salaries, just other tangible costs. But there's other things that come into play when you're thinking about spending money. For example, let's say your partners decide, hey, we want to go build a new surgery center, right? You need to go borrow money. Now you have to pay interest on the loans that you borrowed. In addition, your taxes are, depending on how you report, but even then you have accounting principles where you have to put in depreciation and amortization, and that adds an additional expense to your bottom line. So, the truth is what EBITDA is used for, and that's why we talk about it so much in this kind of deal flow strategic, or why it's so important to know what this number is or what your practice is valued at, is it really can help with the apple-to-apple comparisons of two traditional businesses. So if you have urology practice A and urology practice B, a lot of times that EBITDA number can reduce that financial noise down to a single number. That way you can basically look at, okay, this, under normal circumstances, this is what our business would be worth, but it's not as easy as just saying, gross revenue minus expenses equals X, because there's a lot of other things that might be on your balance sheet that need to be taken into consideration. So that's why we hear so much about private equity and strategics, but the one thing we keep hearing about is this EBITDA. And I've been kind of, in a cute way, been fascinated, because a few years ago when we started talking about this, folks would ask about it, but it kind of was a so what, and now it becomes really the focal point of a lot of partner meeting discussions, which is fantastic. And that I think no matter which direction you go with your practice or what your long-term goals are, it really, one, helps you define your business goals, short and long-term, but two, it really helps you to decide, how you're going to structure your business long-term. And I'm finding that our groups are having much, much stronger strategic business discussions from a financial standpoint than I've seen since being on board in urology. So just to kind of give you an idea of how a private equity, and I would say the same thing if it was a strategic. I just don't have a good strategic model that I can point to right now. But if you look at kind of how a private equity partnership is set up, usually there's a partner, a general partner private equity firm, and then they create a private equity fund, or, they create, let's call it, Urology USA 101. They create that fund, and then each one of their portfolio companies go underneath that. Usually, and for those of you who've been in these discussions, this is going to be very simplistic, but usually the way this works is there is a platform group or a foundational group that has strong operations, good leadership, a good structure, the ability to grow. They've actually set up a structural backbone for the way that they're doing things, and they're able to basically be a platform for additional groups that come into their portfolio. I think that the confusing thing, everybody initially thinks they're a platform, or two, they feel like if they're not the first one to the party in the platform that all of a sudden they missed the deal. And neither one of those is the case. However you run your business is going to be the most important thing, and what your long and short-term goals are of your business is the second most important thing. You may or may not be a platform. You may or may not be a group that is looking to even do this, but the important thing is to have a very clear vision and mission around what you're going to do and how you're going to go about it. And then the second thing is to really run a good balance sheet. And again, when you think about that earnings before interest, tax, depreciation, and amortization, how are you running your business? And I think that's the biggest thing. If you have a good bookkeeper and accountant, they probably could run these numbers for you pretty readily. What I find with a lot of our groups is that, you know, they've really never thought about their business from this perspective. They've thought about it, and, you know, a lot of times the biggest thing that I see in almost all the books I look at is most of our groups cash their partners out, for example, at the end of the year every year, and they don't leave a lot of money in the coffer or the kitty. So when you go to value your earnings before interest and look at the overall multiple or overall bottom line, the reality is there's nothing out there to build infrastructure in the future. And that all of a sudden changes the valuation of how you look at your company. And this is not confusing, but a lot of times it sounds confusing. So if anybody has any questions, as always, you can always shoot me an email, or I'm happy to go through this. And like I said, the deck and the information will be online after this call, or later this week, I should say, because we're finalizing some things on our website. So I just wanted to talk a little bit about, there's different strategies, both with private equities and long-term strategic, but even if you're doing a roll-up independently, whoops, and guys, if somebody can mute really quickly, that would be great. Traditional private equities or even traditional strategics are focusing on value creation levers in order to enhance their performance over a shorter term. And these are some of the things that, and these are things, guys, even if you're not going to acquire a business, sell your business, merge with another business, these are just things that I think make you better regardless. There's a lot of things in this deck, and there's a lot in the back half of the deck that we're not going to even go into this evening, that really helps you to just run a better business. So thinking about your short-term earning improvement, you know, there's two ways to do it, right? It's to raise your top line revenue or to cut your expenses. You know, looking at your financial restructuring, we still have a lot of groups out there that are running a lot of practices, a lot of footprint, and not a lot of reach. So, you know, does every practice, or does every location in your practice really generate, one, the right revenue? Two, are you maximizing your patient base there? Three, are you maximizing, you know, every bit of your clinical guideline possible and patient identification? And four, are you really thinking from an infrastructure standpoint, not in a year over year or month over month scenario, but what you're building for the longer term of your business? M&A, if you're going to add on practices, I do have a fair amount of practices that are talking independently about getting married. You know, what does this help you with? A lot of times there's smaller urology groups across the country that aren't doing advanced prostate cancer to the level that they could if they were a part of a larger entity. They don't have an office dispense. They don't have the ability to treat patients. They're more general urology based. So they're treating, you know, a little bit of everything, but not a lot of anything from a subspecialization standpoint. Synergies really can help you in order to, you know, really look at your cost reductions and improve your earnings. And I mentioned at the beginning of this call, but the majority of the groups that I am seeing that are really doing a good job strengthening their footprint this year, even if they're not going to a larger entity, or even if they've merged, but merged with smaller partners, is they're really starting to talk to their smaller partner groups in the area and starting to talk about economies of scale long term. When it comes to longer term holds or funds, and the way I look at this is if you're thinking about really what your practice is going to look like, you know, let's talk about 5-10 years from now. You're not looking at a shorter term performance measure. Some of the things that you want to be considering is, how are you wanting to expand into new markets and new geographies? You know, I mentioned the smaller urology groups. Let's say you're the platform or the hub of the wheel group. I always call it the mothership group in the state. How are you adding on the satellites to strategically strengthen your footprint, recognize new patient base? what new products or business lines, can you bring on to really think about that long-term growth? I mentioned the opportunity of ambulatory surgery centers, but we have a lot of groups right now that are looking at very strong men's health programs, a few groups that are really looking at alternative payment models, alternative payer strategies, and really thinking long-term about what other ancillaries they can add into their bottom line in order to really strengthen their urologic footprint or uro-oncology footprint long-term. There's also an opportunity there to add strategic partners in order to really recognize that long-term growth. And then, last but not least, but obviously new and innovative technologies, and then strategic acquisitions at scale, rather than doing, bolt-ons or, like I mentioned, the mothership and the satellites. But, are you looking above and beyond your local geography, your state? There's a few groups that are really talking over state lines, even talking about, hey, maybe if we don't get completely married, or if we don't look at something long-term, how can we take advantage of either payer opportunities if our payers scale multiple states? Very difficult to have those negotiations. The other thing that really can be beneficial here is having corporate discussions. So I know I'm a former employee of GE and a former employee of another large Fortune 500. Both of those companies now have created strategic opportunities where they've actually negotiated contracts with certain hospitals across the country for their employees' care. So for any of you who have large employers in your state, absolutely, could possibly acquire a geographic area that might be something that's beneficial to a payer or to a corporation that would make sense. So, again, a lot of this will be available online, so I don't want to overly, read the slides out, but if you're really thinking about what is a private equity or strategic looking for when they're coming into your business. So if you're valuing your business and you want to talk the talk, right, or you want to negotiate appropriately, or you want to at least sound relevant to the person on the other end of the lens or line or meeting, these are the types of things that you're going to be asked. We talked about revenue, top line revenue, and EBITDA, right? What is the size of your group? How many partners do you have? More importantly, how have you managed your business? So, have you built a ton of infrastructure and you're not really sure now how to kind of cover it, and you're having to go back every partner meeting and ask your partners to chip in more revenue? Do you have outstanding bank loans? Do you have outstanding real estate that you haven't looked at, where every, 2 doctors are in this building, 4 doctors are in this building? Have you thought about how this truly affects your bottom line and what your actual EBITDA is in your practice? And then what outstanding obligations do you have as a group? What are your margins and profitability? What are you doing to basically align with clinical guidelines? How are you maximizing your profitability as a group from a payer contracting perspective? And how are you running your business? At the end of the year, every year, year over year, are you growing? Are you not growing? Are you flat in your revenue? And what is your plan to basically move that forward? What's your historical performance? And I think this is a really telling. I have a couple groups who have recognized a really nice pop this year because of some of the acquisitions that they've taken on. And so they've added, like I mentioned, new doctors into their space that all of a sudden maybe weren't doing APC, just using that as an example. So all of a sudden they look like they've hockey sticked in certain areas of their group. That's not a historical performance. That's all of a sudden recognizing economies of scale. Not that it's not sustainable, but that's definitely not something that you can just say, oh, we've been doing this year over year for the last 5 years. We're a great group. Time will tell, right? And so it's really being able to think through what your historical performance is. That's something that you would want to know if you were buying a business, right? Who's the management and leadership team? What's their long-term plan? What the geography is? Is it a geography that's going to grow? Is it a geography that's going to be under duress? And what's your long-term growth potential? If from the flip side of the equation, right? If you're looking at the other side of what kinds of things should you be thinking about if you're, and again, this can be something that is not just, it's not just something that is a private equity per se, but also could be a strategic discussion. Again, I just pulled this because I think it's a good cheat sheet for the sake of this discussion. But, what kind of investing opportunities, how much control do you have over the long-term investing of the group? How much capital is out there? How operationally focused Is the PE or the strategic longer term? What's their average investment hold period? And then, what kind of uninvested capital is left in the fund, and what's their long-term goal? What does this look like a few years from now? And most importantly, and it's not on this checklist, but I think it's something to be very mindful of, is what's the culture like? And I think that's the biggest thing, whether it's a merger that's an organic merger, a strategic merger. We just haven't had a lot of those, frankly, in urology, or a private equity. What does that parent partner look like, feel like? How does it work under their direction? And how much opportunity do you have to really have, the control is the wrong word, but what does this actually do to change the cultural footprint of your group moving forward? And I think those are really, really strong questions to ask. Having gone through a lot of this myself over the last 24 months, both internally and through some deals externally with the groups in the country, I think the important thing is to just really, really be wise about the partner you choose, and then make sure that you're obviously focusing on the left-hand side of what you can control within your group. These are some of the things, how do you prepare, right? And I'll talk a little bit through this, and then, we'll probably end a little bit early on this call. There's a lot of back details in the appendix of this deck that'll be available as far as how to actually look at, your cash flow analytics and what have you within your group. But these are some of the due diligence performance metrics that you would be asked to provide. And then this is a very busy slide, so I apologize, but I wanted to make sure you had what you needed on here. But the bottom line, and this is why due diligence takes a fair amount of time, is it's really looking at your financial statements, your quality of your earnings. How do you account? How do you do your accounting? Are you on a certain metric basis? How do you basically perform? And do you have edited cash flow analytics? So there's a lot in the financial category that just that alone takes some time. These are all good practices, guys, even if you're not looking at doing anything this year or next, regardless of your merger situation, regardless of whether or not you're going to be thinking about PE. This is a really good checklist to think about how to go about each one of the pillars in this area. From a financial standpoint, do you have your house in order? Do you have all your contract negotiations somewhere where you can find them? Are they found for a long period of time? Is there that random piece of equipment that somebody bought sometime that you're still paying month over month on the lease and you're not sure where it is? All those little details, and I'm somewhat being coy, but all those little details are something that comes into place. Things that you probably should have already in a good place, but for those of us that, and myself included, for those of us that are business owners, a lot of times these are the things that, unless you have an accounting firm involved or you're doing edited accounting financial statements every year, things just naturally tend to fall through the cracks. So from a commercial standpoint, and I would look at this from a payer standpoint, but what's your market overview? What are the trends in your area? Do you have a certain market expansion opportunity in your area? Just kind of what are some of the things commercially that you're looking at, and then operationally? Do you have checklists that you're following for your staff? Are there revenue and cost assessments? And do you have an ability to really systematize, I'll say, your business structures? If you have a call center, or if you have certain ways of doing things from a payer standpoint of negotiation, how exactly are you going about that, and what kind of systems do you have in place operationally, and who's manning the ship long term? Are there backup plans in place for the rainy day operation? You can read through the legal stuff, but basically I mentioned some of this when it comes to your contracts that you have in place for your ASCs, for your partner contracts, for any partners that came on board, for any governing documents of your groups, just making sure that you have everything in place. And then, your other piece, your technology systems and what have you. But this is just a nice, kind of pillar checklist, if you will, of some of the things that would be critical when you look at due diligence. And then I did the same kind of thing just as far as what the transaction process actually looks like, because I think a lot of folks, until they've gone through it, or, we're a very fraternal specialty, folks are like, hey, what happened once you did this? This kind of gives you a good idea of what does that look like, and I'm finding we're getting much more conversant. When I first started talking about some of these deals a couple years ago, everybody would say, oh, I signed an LOI, and nobody really knew what that was. I mean, but a letter of intent, what does that actually mean? If you go from the left-hand side to the right-hand side of the document, this is exactly the steps that you would usually go through, and then who would be involved, usually from start to finish, in a lot of those discussions. And this would be true on any deal. I would encourage any of you who are doing large-scale mergers, let's say you're bringing 3 groups together yourselves or trying, this is also a good roadmap for that. I find that those mergers can be very taxing on the group just because you're trying to practice medicine and merge a group, and even with outside consultants or accountants or lawyers, it can be hard to have somebody managing the overall process of the deal. So this is a good roadmap of what that could look like. And then obviously, just like anything else, having a timeline and really being able to put in, what milestones do you want to achieve? How are you going to get there? These documents, I find too, for partner meetings are excellent just to educate your partners. A lot of groups have brought me in this year to just educate them around the process because they don't understand how the operations of an actual deal work. And so, like I said, that was the evolution of this call was exactly that, to try to really kind of educate at a very, very large scale on what it is, how do you value your business, how do you try to make a decision on which direction to go, and what does a roadmap to that solution look like. And then last but not least, and I'm not going to go through the slides, there are slides that actually detail the different approaches to valuation on the back part of this deck, and it's too detailed to go through in an hour-long call. It just wouldn't be fair to the audience, but it will be available. But there's different ways that you can look at valuations of your practice. Again, if there's one thing that I think we can talk about very well, it's that EBIT discussion, because that is an apples to apples way to value practice. But there's discounted cash flow valuations, relative valuations, and then contingent claim valuations. And these are just things to be mindful of how different entities, if you want to call it, but how different entities would look at your book of business. So there's different ways to look at this. For those of us that aren't CFOs, or even those of us that have MBAs by background, this gets very technical in the way that you look at a business valuation. But I think the important thing for this is not necessarily to go back to your partners and try to, train them up on all things financial, but to really talk about the beginning of this deck, which was the changes in the marketplace, all the different changes to the landscape, and why now more than ever, urologists and urology groups need to be mindful of how to manage their bottom line, how to look at their business as a business, not just kind of come in, turn on the lights and practice medicine, but really think about the short-term implications of the things we're doing as a group and the longer-term implications of the things we're doing as a group. And last but not least, I think that the end-all be-all of all of this, just because it's really critical, is the valuation and the goals of your practice are completely reliant and contingent on the fact that you're rowing in the same direction. And I think that's the biggest thing. The groups that have the highest opportunity here are the groups, if you go back to, a few slides ago, but the groups that really have thought about that left-hand side of the equation, not just what their EBITDA is, because that will usually, take care of itself if you have good financial people involved in your practice, but really about who is your management team, what's your geography, what's your plan for growth, and how has your historical performance started to lay the foundation that will dictate the most promising future. So with that, I'm going to go ahead and close. I would love to open this up for questions, but we have had so many people RSVP for this call. I'm somewhat concerned that if we do, we'll be on the call for a very, very long time. Most of you have my contact information. You can absolutely email me or the team, and we're happy to take any questions offline. The materials will be available along with a recording of this webinar on the website, so feel free to go back and reference it. Our website is finishing its maintenance, so we should have this up by the end of the week. If anybody has any other questions, please let me know. But we've had such a great turnout around this topic. We're going to continue to educate, and probably we'll do another webinar to this end in the next couple of months. So with that, I will close and appreciate everybody's time, and we'll look forward to hopefully seeing you guys at the upcoming urology meeting. Take care. Bye-bye.